From Embark's headquarters in Dallas, Texas, you're listening to Accounting Matters. I'm your host, Adam Olson, Embark's Accounting Advisory Practice Leader. On today's episode, we're picking up the second of our three-part mini-series focusing on the deal's transaction lifecycle. I'm happy to welcome back to the podcast studio one of our, I'd say frequent, podcast guests here, Chase Anderson, who helps lead our capital markets practice here at Embark. Chase, welcome back. It's been a bit, but happy to see you in here.
Adam, thanks for the invite back. Always glad to be in this room and talking with you.
Yeah, of course. So happy to, have this conversation with you today, Chase, to talk about all things related to companies as they acquire new businesses, look to streamline these new businesses that they acquire, and ultimately grow them as part of that kind of middle phase of the transaction life cycle. So with all that in mind, Chase, I want to maybe help set the stage a little bit. So in my first episode, I had a conversation with Drew Solomon from a transaction services perspective, kind of talking about all the things that go into the M&A strategy of a company, thinking about identifying who's the right target for them, performing the due diligence that needs to take place to ultimately make that decision on whether or not they want to buy or not buy a business. So with that context in mind, where we've kind of left our listeners off at, can you talk to me about what happens next? So once the due diligence dust, we'll say, has settled, the buyer, seller, they're both kind of aligned and ready to move forward with the deal. What happens next?
Yeah, great questions, and happy to be here, and glad you're able to talk to our friend Drew Solomon. Probably talked a little bit about Dave Matthews Band too. little inside joke here at Embark.
Did not get into any of that specifically. He was very, very had a lot to say about the deal itself, but definitely didn't get into his music just yet. Next time.
Yeah. Well, I like to think about it in two different ways. I'll try to cover both while we're here. And so you have a platform acquisition, which generally is a private equity group is going out and they're buying a brand new company, changing control, and they're taking it over. And then you also have what we'll refer to as tuck-in acquisitions. A company's established and just going out and doing their own acquisitions and kind of adding to the pie. So I'm going to try to talk about both in the context of this conversation. And so please chime in if I'm getting one or the other.
No, happy to hear both.
Yeah, but due diligence has occurred. You get this beautiful PowerPoint or PDF deck that's 80 pages of numbers and text, and now you need to go do something with it. And so they're going to move forward with the transaction. And so what happens next is generally, I like to phase it into four kind of buckets. You are going to now negotiate,
okay.
You're going to approve, you're going to finance, and then you're going to close.
Okay.
And so within that, I'll kind of cover a few of the sections of that. So some common terms we're going to hear are definitive agreement, and that's the negotiation phase. You're going to put pen to paper, lawyers are going to get involved, and you're going to start taking a few page, let's call it letter of intent, that lays out the general terms into a full-on legal agreement. And so a lot of back and forth on that. So you're going to have a definitive agreement, and the negotiations are going to occur, and then you're going to finalize it. And probably sign it and execute it. So once that then happens, then it goes to the approval process, and there's a few parties at play. There's obviously the government, we're in the US of A, and so you're gonna have regulatory approval and antitrust approvals that need to occur. Looking for things like monopolistic behaviors. Certain deals recently have been denied because they're gonna be too large in terms of competition. After that, or at the same time as that, you're gonna have shareholder approval if that's required.
Right.
Board approval, maybe shareholder approval to say, yeah, we're going to move forward with this deal. The terms are okay, and let's proceed. Once you get the deal signed, the approvals in place, oftentimes you need to go get backup financing for the deal. So a lot of the M&A that we see today requires debt to finance the deal.
Sure.
Leveraged buyout LBOs are still a thing. Large amounts of debts are used to acquire businesses. A few of the final things then are going to be a clearance of contingency. So before the closing, both parties must fulfill any contingencies or conditions specified in the agreements. And those are usually very long and legalese written sections. And this may include third-party consents, legal matters, or meeting certain performance targets.
Yeah, clearly legal counsel advisors are a huge component of any deal. Closing and kind of moving forward with that. So no surprise there. I will just add, we talked a bit about, certain public companies that maybe making strategic acquisitions or whatever, that there are specific rules to SEC registrants just to kind of keep in mind. So Rule 305 provides additional reporting obligations that companies do need to think through, as well as filing, Form 8K requirements associated with certain acquisitions. So just a shameless plug, we did do a podcast recently on that, talking with Janet Gregory. So definitely check that out for more information on that. So once the transaction, so we've closed, the transaction itself is sealed, signed, delivered, whatever you want to call it. There's a number of accounting and reporting considerations that now take place for the acquirer. So we've talked about probably a lot of these that we'll get into, I'm sure, today on past podcasts. So definitely encourage people to check out some of those past podcasts for maybe a deeper dive. But can you kind of just talk through just kind of high level, what are some of the more key accounting type reporting considerations that now the acquirer has to think through now that they've closed and acquired this business?
Yeah, absolutely. This is where I'd say I spend most of my time. So
Okay.
I'll try to keep this as brief, knowing that we got some more topics to cover. But the first thing that comes to mind, it's just simply closing the books.
Sounds simple.
Sounds simple, but it can be oftentimes very complicated in the sense that you want to plan very strategically ahead, knowing when are we closing this transaction and why, and if we're going to close it on a non-month end, are we doing this the right way from a timing perspective and a resource perspective? And
Right.
so,
Deals don't always wait for what's convenient for accounting, right?
yeah. And so I like to think if in a perfect world, you would close a deal on the first day of the month, 12:01 a.m. on the first of the month, because that way you have your books closed, doing a typical month-end close, and everyone just has to do it once, and it's pretty clean and simple. But oftentimes that's not the case. And so you might do a mid-month transaction that people don't plan for that. And so the accounting department closes a normal cycle and then never closed the mid-month cycle. And so now you got to go back and do a reclose on a period that's either past or being jumbled up with the current close and the current requirements that just, a snowball becomes just a massive, massive effort. It's a snowball effect to try to fix. And so I've seen just a lot of effort taken to close the books appropriately.
Yeah.
It's not planned.
And when people acquire businesses, like more or less, they always have the same accounting policies as the acquirer, correct? So there's really no need to figure out any accounting difference. I'm joking there.
That was a joke. Yep.
Yeah, I know. I'm sure you can speak to this a bit, but just the differences in accounting bases, or, if someone's even on accrual or US GAAP based accounting.
Oh, yeah.
Like just having to kind of sort through some of those. What are some things that tend to come up in that space?
Yeah, everybody likes to think that how they were doing it was good enough, and it's going to be good enough. And
Sure.
Oftentimes that's not the case with the new buyer. The new buyer is going to be bigger, more sophisticated, and have different reporting requirements and expectations. And so, what might have worked for a small mom and pop using QuickBooks to kind of just get by, it's not going to work for a bigger company that's on, let's say, Oracle or NetSuite. And you're going to have to go through really account by account and make sure that it makes sense. The data is supportable. It can support audit. Policies are consistent. Expectations are consistent for the go forward of the business. And so, a lot of times we see cash basis businesses that are acquired by GAAP filers. We've seen oftentimes a lot of kind of hybrid GAAP is what I'll say. It's,
Yep.
Good enough GAAP that supported, a lot smaller firm audits. But once they go to a bigger firm audit, it needs to be full on GAAP. And so we see a lot of work and cleanup that has to get done to support kind of these new requirements of the bigger buyer.
Yeah. And we've actually done another podcast, surprisingly, talking about cash to accrual. So definitely check that out as well. So I know
I will say, I'll just interrupt you, as an ex-auditor, for any company that has significant inventory,
yes,
just plan your inventory counts
for sure.
well in advance,
Yes.
because that is something that always will have to get audited,
Yes.
generally speaking.
And clearly, like a lot of these things, these differences that we're talking about are already right. They're identified through the diligence process. So companies know as they're moving forward with this deal, if it's, it's not a condition of the close itself as having these things already taken care of, it's going to be something they're going to be tackling once the deal is closed. So it's on their radar to start moving forward with, but nevertheless, it's a lot of work, right?
Yeah. I interrupted you. You were talking about the podcast.
No, all good. So I know some of the major accounting standards, right? They can introduce complexities. in a transaction post-close. So revenue recognition, leases, and now CECL are kind of the big three that tend to come up more often than not. Can you talk to me a bit about what you see as when people acquire a business about needing to either kind of, I want to say, relook or reassess kind of the accounting conclusions, or whether or not they've truly applied some of these major accounting standards? What do you see like having to sort through kind of in that space?
Yeah. I'll start with materiality. Always kind of go in there and saying reassess materiality.
Sure.
And kind of get to the level you expect. If you're going to be bought by a public company, materiality might be significantly lower or higher, just based on the size of the business you are running. So start there and kind of get a sense of the population. But from an acquisition standpoint, the historical business, and we've had conversations about this, it's essentially a new entity. It's a new reported entity, or could be a part of a new reported entity. And so taking the time to have the fresh perspective of kind of reassessing from scratch what's been done. And so you covered a few: revenue, leases, and CECL, but I like to cover oftentimes functional currency. Mm-hmm. I see a lot of these businesses that get purchased with multinational footprints that will ask questions about what was the functional currency, how was it done, and what's the expectation going forward. And surprisingly, a lot of times there's no documentation. It was just like, oh, this company in France is in France, so we're going to use the euro. Well, let's reassess it in the broader scheme of things, because it has a massive ramification when it comes to global consolidation and ultimately push down accounting if that's what's required. That and variable interest entity analysis, VIE, just really taking a step back and looking at all of the relationships at play and saying, okay, do we feel comfortable with this going through audit, that we can anticipate questions that we're going to be asked? So
yeah, some tricky areas of GAAP for sure that I'm sure bring up a lot of questions and a need to reevaluate and just think through a little bit more critically. So another kind of key aspect of deals is, you see it in almost all agreements really, is around kind of net working capital provisions and net working capital adjustments and things like that. Can you tell me a bit about what the buyer needs to do? So the net working capital adjustment, right, is usually a provision that gets triggered or comes into play, post close, right? There's a certain time period. But for those that maybe aren't as familiar with what that means, can you tell me how that mechanism really works and kind of like what companies go through to kind of evaluate that adjustment?
Yeah, this is pretty important, especially because this is real dollars at play after the close that have to get sent back and forth between the buyer and the seller within predefined days. And so there's usually the high of the deal closed, immediately followed by, now we got to get the filing requirements of these agreements taken care of or addressed. And so the net working capital is one where within the deal phase and in the agreements, there's targets generally at an estimates of, the buyers buying this business, they expect a net working capital amount of X based on what they're going to pay for the business of Y. And at close, it's going to be an estimate. And generally it's based on historicals. And at the time of close, that month end close hasn't happened. So it's an estimate. And so within this net working capital true up period, you got to finalize it, and you got to finalize with the most accurate data as possible. And so within generally 60, 90 days, you have to deliver an actual net working capital number based on the close. And that drives either the buyer having to pay more money to the seller, or the seller having to, give money back to the buyer. And, this can go to the magnitudes of millions of dollars if it's wrong. And I've seen it where it's been significantly off, and there's a lot of questions asked as to how could something have been off by this amount of money, because, the funds set up to buy these businesses are very strategically
right. They have a presumption of kind of like what level of working capital is necessary to run the business based on that target.
Yeah.
And if it's way off from that, it's like, are we buying something that's way more capital intensive than we expected?
Exactly.
Yeah.
And then this kind of starts then the legal, I would say, back and forth of the agreement with the buyer and seller, where you hope not to start a contentious relationship right out of the gate with disagreements on net working capital numbers.
Sure.
Because then it could just lead to more and more. Could be a tough relationship. So this is a very key, first out of the gate aspect of M&A.
Yeah. So earlier you kind of touched on a few kind of technical areas that, you may have to navigate with the acquired business. But even from the acquirer side, there's probably some technical accounting kind of, or maybe even operational matters that come into play post-close. So, ASC 805, when you're thinking about kind of, business combination guidance and acquisition accounting that you have to apply, what are some other technical accounting type items that are kind of on the checklist for companies that they have to think through, or that you help companies as part of being an advisor in the space?
And you said it well. The two ways I think about it is you have the technical accounting and then you have the operational. And so from a technical accounting, we'll start with the funds flow as the common term of this large workbook or book that kind of lays out where all the money's going, sources and uses. So where's the money coming from and where's it going? And it, generally it should reconcile to match each other. And so within that amount, that book, there could be numerous units of account. And so you could have just the simple purchase accounting, but you could also have other things like rollover equity that could be a part of the agreement. You could have compensation, share-based compensation awards, bonuses that cover multiple periods, new employment agreements that could be struck at odd hours of the deal phase, where you've got ramifications both on the predecessor business and then on the successor business. From an accounting standpoint that you have to look at, you got escrow agreements that you got to analyze, indemnities, transaction expenses, and then a lot of times you got other areas like debt. Debt was used, so you got to account for the debt. You've got areas like private company accounting elections, if you so choose to use those. We talked about variable interest entities, foreign currency, and then for me, kind of the culmination of a lot of this is global consolidations, which can get pretty hairy through it all.
Yeah, so a lot of areas.
Yep. So there's a lot at play of just a simple purchase accounting, or people think. So then the second thing put that aside as the technical, think about the operational. Now you actually have to go do it, put it into a system. And so you got to think about the legal entity structure, your ledger structure, sub-ledger setup structure. I get back to foreign currency because that's where I think I've seen historically the most amount of pain with, operational push down, but also just, required push down.
Especially when you're acquirer and the acquiree, I'm sure different systems and, things don't talk to each other. Yep. So just putting this stuff into motion is not as easy as you think. Once you've even sorted out what the accounting should be.
Once you get the accounting figured out, it's you think you're done, but no, you got to now you got to go, maybe you got 10 disparate systems. And you got to figure out, how do you want this to work efficiently? Delegation of responsibilities. Who do you want to do what, to manage what? Right. What kind of historical data do you want to keep, et cetera? So there's a lot that goes into the operational side of the house.
Just integrating the businesses themselves.
Yeah, and that's just the accounting integration. That's not even the other integration.
Yeah, you think about just human resources, operations, just in general. Yeah, for sure, a lot there. Related to, purchase accounting and things that you just talked about there, there's clearly one aspect that can't be overlooked, which is the need for fair values, right? It's a component of how you count for businesses under US GAAP, is you have to fair value certain, acquired assets and assumed liabilities. Can you talk to me about just what role valuation plays here, and kind of what companies need to kind of keep in mind when they're thinking about valuing these assets or liabilities?
Before I answer, is there a plug for a Will Carroll valuation podcast, or is that to be continued?
We did do a podcast. I'm trying to remember if it was on specific to business comment. It actually may have been. I think you are correct.
Okay, all right.
It's been a minute, so don't quote me on that.
Yeah. Okay. Well, for a quick refresher though, as a part of an ASC 805 acquisition, you are required to fair value the acquired assets and assumed liabilities under ASC 820. And so with that then comes the need for a valuation report, we'll call it, because generally speaking, most companies don't have the in-house expertise to do the techniques and modelings that's required. Some do. Some companies are so acquisitive that they have just the in-house resources, and then the auditors are comfortable with the outputs. But generally speaking, companies don't have that in-house resource, and so they go to a third-party specialist to actually provide what we'll call a valuation report. And it's a lot of schedules and a lot of numbers and a lot of modeling techniques, and they'll use the word esoteric assumptions, and that you have to essentially do to support how you came up with these derived fair values. And 9 times out of 10 is going to have to go through an auditor and the auditor's valuation team. And so it's extremely complex, and there's a lot of key assumptions that can change things significantly to get these derived values.
Right. And it takes time for those valuation reports ultimately to come together, right? The exercise of doing it. So I think a lot of times planning for that, right? And just keeping that in mind, especially if you have a late period kind of acquisition that you make, and your valuation report may or may not be ready for your kind of external financial reporting, and just kind of thinking through how you'll navigate that and utilize kind of the measurement period and stuff.
Yeah, I will add one thing to be mindful of during the valuation process is to think forward into the future and think through, are you doing a valuation at the consolidated level? And maybe that's all you need. You just need the consolidated viewpoint of this business, or maybe you need it at a more disaggregated level for some future event.
So if you were to carve off a piece of even this acquired business, you would break it down even further in the future.
Yeah,
just
exactly.
having some of these things.
Yeah. A lot of companies will buy knowing that they're going to sell something in the future. Maybe it's not today, but at some point in time. And you can save some time and money today by doing the disaggregated valuation report, knowing that, hey, there's the possibility in the future that you're gonna sell a portion of this.
Yeah. So we've talked a lot about, I think, accounting specifically, implications there. Talked a little bit not just about valuation, but maybe kind of switching gears to the reporting side. What do companies need to be thinking about as far as kind of their new either reporting cadence or obligations? Oftentimes, debt's taken out, there's going to be external financials that are still necessary, audited financials that have to be done. But what other kind of reporting, I'm going to say not always an obligation, but requirements are on the table?
Yeah, expectations. Yeah. So it happens fast and furious usually after the deal is closed. And we just got done talking about the net working capital as a start, and then just even do an operational,
especially if you got a private equity owner.
Yeah, business company. It's not only do you have to do those things and then start putting this in your system and getting accounted for, but immediately starting, you're going to have bank requirements. And maybe that's monthly, maybe it's quarterly. Most oftentimes it's going to be monthly. You have to start doing that. So that's a very quick clip for doing reporting. And then you got your private equity. Oftentimes private equity owner reporting, maybe that's even weekly. You got to give them KPIs. Maybe it's monthly. And oftentimes they're looking at things separate from the bank. So that's another deliverable. Then you're going to have your audit. Oftentimes now you have your annual audit. And if you're a public company, you're going to have quarterly reporting with this new business you acquired. And so you have a lot of reporting requirements that happen very quick. And so it's just another distraction of running the business that you're historically used to running.
Right. And being prepared for all that and having the right resources lined up to help support that. So I think we got a good picture of all stuff that happens once you've acquired and kind of the early days type things. But then kind of the natural next step a lot of companies make once they acquire a business, especially as they're going forward with integrating, is looking at ways they can streamline the business. And some of that is, a little bit more operational in their decision making. But if a company's looking to quote unquote streamline their business, what are they looking to actually achieve here? What does that mean? Yeah,
that's a great question. It's a big question. And, a lot of times you're going to hear the word synergies most oftentimes, especially in the due diligence reports, but they're looking to reduce redundancies, eliminate waste, and find ways to take these two businesses, maybe it's more, and find opportunities for unlocking value and growth. So you can unlock value through growth, and you can unlock value through reducing excessive costs. And so, during the diligence, they've probably identified how they're going to start to do that and what's driving the value of this business, what they're really going to pay for it. And now it's just a matter of executing and starting to do step by step, who is going to get reduced? Yeah. What's this new business going to look like as a whole? And so there's different ways to do it, and different organizations have different ways of doing it. And some will go in and buy and not even cut costs, and they're only focused on top line growth.
Yeah.
They're kind of
so it kind of depends. Yeah. Type of business, the deal structure, the industry, and obviously what's the acquirer's kind of investment strategic objectives, what are they looking to accomplish with this investment they just made. So you mentioned like cost reductions. I imagine that's very common. See that pretty often, right? Looking for redundancies and things like that. But what are some other strategies or things you see when companies are looking to streamline that are often used, like other than cost reduction?
Yeah, I'll cover some of the ones that I like to that I see the most. So we talked about cost reduction. So that could be anything from duplicate functions and roles. Optimizing supply chains, that's pretty key. Negotiating vendor contracts, and centralizing administrative services. So creating shared service centers, which is very important. If it's a manufacturing business, consolidation of facilities, as simple as that. If you got excess warehouse capacity or production capacity, use one facility versus two. Save a lot of money there.
Or if the acquirer has location somewhere where the existing business is, you may consolidate and things like that.
And even with facilities, you can go things of just analyzing your leases. Do you want to lease? Do you own your facility? Do you want to do a sale lease back to unlock some additional capital? That's at play. Technology integration. Obviously, now you've got two of essentially the same of things. So which ones do you want to keep for the business, and where is it going to go, to make sure you're thinking about that the right way? Product and service rationalization. Trying to identify the key products, the primary drivers, the high margin products, and maybe it's time to sunset some of the other ones. Sales and marketing alignment. So going as a cohesive strategy to the market to, again, grow top line. Finance and accounting integration. That's our bread and butter. And talent retention. That's huge too. So there's a lot of plays. Hopefully that answers some of the questions. I don't know if you've got anything you'd like to add as well.
No, I think that's a pretty exhaustive list, but a lot of good examples there. But I know, and I can say I imagine, but I know this, there are challenges when it comes to streamlining or just integrating, two different businesses, or even just having a new ownership, for a kind of a change in control type transaction itself. What are some of those challenges that come up with trying to do this integration, streamlining? What are some, I feel like this starts to get into more of like the psychology of the way businesses run as well. But can you talk to us a bit about some of the things that you see or you hear companies talk about as some of their struggles? Yeah,
I would say the most common one we're probably used to is the cultural integration and issues that can occur there. You might be at a company and you love it and you loved what it was built around, the vision, the mission, the people, and then you get bought by somebody that...
Yeah, especially if you go from like a founder business to now you've got this big kind of corporate over. Yeah.
A lot of people don't like that. And so that cultural integration can cause a lot of problems. And Twitter was probably the most recent high profile example of that, where it's in the news, it's public, and it's just going to be such a cultural clash that can almost distract from what you're trying to accomplish with the actual acquisition. I would say kind of tied to cultural is also just employee morale and retention, which is there's a lot that happens in these transactions, and people start to worry about, are they going to be a part of the reduction? What does their future look like? Are they going to get fired? Is somebody else going to get brought in to replace them? Because they're thinking about their lives and their financial livelihood, but also they're just in the accounting department and the finance, they're very busy. You've got all the pre-close activities, you got to support diligence. Okay, then the deal closes. Now you got to either do a duplicate close if it's a mid-month transaction, then another close, then you got to do net working capital adjustments, then you got to do reporting, then you got to operationalize it, then you got to get audited. So it's just this nonstop, just under the gun.
Lots of nights and weekends there too, right?
Yeah. So that's another thing. We talked about redundancies and layoffs. It's a long list. So, but for me, it's the cultural and the employee morale that I see the most.
And that makes sense, right?
Yeah,
people are some of the most important assets to go along with an acquisition, right? Just the institutional knowledge, and even for the acquirer, like, those folks that really kind of maybe help bring this deal to a close were a part of that process. And it doesn't always stop there. Once the deal is closed, there's a lot of work to do after.
Yep.
For sure, for all people involved.
Yeah, maybe a couple others. Organizational structure challenges. Who's actually in charge? Who do I report to? When are decisions being made? Do I listen to that person's decision? You get a lot of that.
Yeah, change management is huge, right? Just having someone that can help facilitate a lot of this stuff is important, and having consistent messaging.
Yeah, and then you're going to have technology issues too. Of you're going to go from 2 of everything to 1. Along the way, there's going to be very huge challenges of data migrations and cutoffs of information and learning new systems and techniques, and a lot can go wrong with data that we see.
Yeah. Okay, so once a company is acquired, now they've streamlined and integrated. We kind of covered those aspects of the business. I think it's fair to say that everyone's then looking to grow that business itself, or their investment in this business. So what are common ways that companies try to establish this growth with the acquired business? What are things you see? What are strategies that are often used to help accelerate that growth? What can you tell us about that?
Yeah, I'll
and there's no right. There's so many ways companies
ways.
Grow, and so many strategies. So obviously,
and a lot of like industry specific too.
Sure.
You got like life sciences where they do M&A then they just keep doing massive investments in R&D to hopefully grow and unlock a new product to them. That'll drive tons of growth, or enter into JVs and the like. But what I kind of see as the main thesis for M&A to help grow, it's kind of getting back to a few items. It's like, why are you doing this? And really it's, you go and buy something because it's just quicker to acquire it. Let's say it's a product or a service, than to actually develop it internally yourself. And so once you kind of got that mass, you can buy it, and then you can kind of put it through your marketing channels, and that can help grow it. You buy something to enter new locations that might have been too daunting for yourself to also implement and do yourself. So whether that's going abroad, you can buy an established business abroad, and then again hit up your marketing channels and your partner and customer channels and grow that way. You buy for new access to customers, and also taking a competitor out of play, I say is really important. It's you can grow by just dominating market share. If somebody was a new up and coming was going along, and then you bought and take it out of play, and now you're the only one left. Well, that's another way to grow, because you can only buy from you. Tax benefits is another way to, it's an odd way to grow, but you can grow that way.
Sure.
And so, but holistically, getting back to it, it's, I kind of view it as 4 ways of just simple growth. And you're going to invest in the product service that drives the revenue. So I'll just call that R&D. You're going to invest in the people, the processes, or the systems. And so I say those are the ways that I view of like, you're going to invest those M&A dollars.
Those pillars are the ones that you put
Yeah.
Okay.
So hopefully that answers your question.
It does.
It's kind of roundabout.
I know it's a tough question to answer too, because there's obviously a number of strategies that can be deployed.
It's a very theoretical question too. It's
always a thought-provoking one to end it on, and I think that's what we'll do today. So definitely appreciate you sharing your insights, joining me today. I know we just kind of scratched the surface on some of these things, because there's a lot we could have easily gotten into much, much more in depth, but definitely appreciate your time today.
Yeah, absolutely. Thanks for having me.
Yeah, of course. And for those that have been following our transaction Lifecycle series, we will conclude with the 3rd installment, where we explore saying goodbye and looking at all things divestiture related. So be on the lookout for that. In the meantime, for Embark, I want to thank our listeners for following along on another episode of Accounting Matters. We'll see you next time.